Welcome to the Coffee and Crypto channel. Today we're going to be doing a slightly different video. It's going to be called TeA and Crumpets, where we're looking at technical trading ideas for entry and exit points in this current bull trend we're seeing. So what we'll be doing is just a quick overview here of what we'll be looking at. We'll be looking at which indicators we'll be using for our technical analysis, with a quick explanation of them. We'll talk about why we'll be using them. We'll have a look at them on the charts, and then we'll talk about a potential strategy we could use from putting them all together. And then finally we'll just have some general considerations and just general chit chat about how to use technical analysis in conjunction with other things. As always, there's a disclaimer that this is not to be seen as investing advice. This is just for entertainment purposes, and all investing and trading in the crypto market does involve risks. Any decision to place trades in the crypto markets is a personal decision that should only be made after thorough research, including a personal risk and financial assessment. And perhaps you might want to engage the use of a professional assistance to help you if necessary. Okay, so again, it's important to note this video is for educational purposes only. Okay, that said, let's have a look at what indicators we'll be using. The first one is the relative strength index. It's a momentum indicator which traders use to determine whether a market is overbought or oversold. It uses a two-part calculation and works over a certain period. The default period is 14. Okay, and the first calculation is made with this formula on the screen, and the second one uses this formula to smooth the results. So if you're interested in the maths behind it, that's the formulas used. And these formulas will give us a number, and this number will range between 0 and 100, with the higher the number indicating the market may be overbought and vice versa. Generally, 70 is considered overbought and 30 oversold. These numbers, of course, are guides and won't prove sufficient in a strong trending market. So, say for example, you're in a strong bull market, it might go up and past 70 and stay above 70 for a while. And then when it does come back, it might not go as low as 30, it might come down to 50 or so, and then that might be considered that's oversold in a bull market, and vice versa if we were in a bear market. Okay, so just to be aware of that. The second indicator we'll be using is the Bollinger Bands, and Bollinger Bands use a moving average with two bands above and below them. The bands above and below are calculated using standard deviations. So if you're familiar, if you've done maths, and you might be familiar with standard deviations. So the Bollinger Bands are they're used to show volatility. They expand as price action becomes more volatile, and they contract as it eases. The default setting on these is a 20-period exponential moving average and two standard deviations for the bands. So if we were to look at a bell curve distribution, two standard deviations will encompass 95.4%. Okay, that's on a normal bell curve distribution. However, markets are seen as fat tails, with rarer events more likely to happen. So just bear that in mind. But for the sake of it, we'll go with saying it's a bell curve, and that these two standard deviations should encompass 95.4% of all where the action should be. Okay. The third indicator we're going to use is the Fibonacci Retracement. Okay, these are based on numbers identified by the famous mathematician Leonardo Fibonacci, and they're used to draw lines on the charts, and they could show potential key areas of support and resistance. Just how they work on ratios worked out by dividing numbers in the Fibonacci sequence. So for example, the 61.8% is worked out by dividing one number in the series by the number that follows it, and the 38.2 ratio is discovered by dividing the number in the series by the number located 2 spots to the right. Okay. And often traders also use the 50% level, and you'll see we'll be using that later as well. So that's the Fib Retracements. Okay, so now why would we want to use all of these in conjunction? So the RSI is a useful indicator to see when the market is overbought or oversold, and the Bollinger Bands can act as a guide to see volatility and help us gauge price action. And as most bull runs include pullbacks or dips, I believe the best way to predict them is with the Fibonacci Retracements. Okay, so we're trying to combine all three of these to give us different angles on what the market's doing, and then help us make predictions and take courses of action as part of a strategy. Okay, and with these indicators, it can be more useful to use the default settings, which I said earlier, there's default settings on them. It's just works. These things usually work better when you're going with the crowd, and however, most people will leave them on most traders will leave it on the default setting. Okay, so we're trying to predict when the smart money will take profit and stuff like that. We want to see what they're seeing potentially, and they're more likely to be using the default settings. Okay, and we do want to be able to predict with these indicators so that we can make a strategy. Otherwise, just plotting these retrospectively, it's just a bit pointless, a bit academic. So we do want to be able to actually do something with them that could benefit us. Okay, so and another thing to note, that all these indicators can be used on any time frame, chart, but they can prove more informative over long periods. Okay, so when you see us doing it, we're going to be doing it on the 1-day charts. Okay, and another thing to note here as well, just to point out, is these are not a replacement for any fundamental analysis or the better Bitcoin technical indicators such as the NUPL and the Firmacap. Okay, so if you don't know what they are, make sure you go and check out some of our videos explaining these, some of the early videos explaining them. Really important that you get a grasp on that. So just, hopefully these can, what we're doing here, this technical analysis, is more of a supplement for those things. Okay. Okay, so that said, let's have a look at the chart here where we've put these indicators on. And so we've got this daily chart here from the end of December 2020 till the 8th of January 2021. And the first thing I'd like to draw attention to is the RSI on the 19th of December, which you can see formed a high of 78.82. And if you remember earlier, we said anything over 70 is potentially considered overbought. And as you can see, the RSI, it was sustaining highs. It was very high. And as you see, it managed to get to 89.35 on the 8th of Jan. Okay, so that's, that's considered very high indeed. Okay, so that's the RSI on there that you can see. The second thing to notice, you might notice, is the Bollinger Bands. So they're the green lines, and the brown line in the middle of it, that's the exponential moving average, which is set at 20, and the green bands are the 2 standard deviations. Okay, so if you see that high that was formed on the 19th, just building up to that, you can see that the Bollinger Bands were starting to expand. So that was showing us, that was indicating extra volatility there. So you can see that move as they were restricted there right at the start of this chart, around the 11th, 14th, and then they expand outwards. Okay. Also, with the bands there, you might notice that the price doesn't often finish outside of them, as we'd expect. That's it moving away from a 2 sigma event as it moves outside of that. So that would be seen as rarer. And if you look at it there, so on that high on the 19th, you can see it had finished for 3 days outside of there. And then if you look to the end of the chart, where we're at the 8th of January, it was currently on a 3-day run where it was finishing outside as well. So you can see the rareness of that, and what tends to happen when it does go outside of it. It tends to just to ease back in. It's going to want to regress to the mean and just come back in. Okay, and the third thing that we on the chart that we can see here that we talked about on our indicators is of course the Fibonacci retracement. And when you draw one of these, you need a start point to plot it and an end point. So here we've chosen the start around that 19th of December pricing, and we chose the end on the 8th of January. So the 19th, you can see the price was circa $23,781 US, and the end there, the high is at circa $40,698 US. Okay, so why did we choose these 2 points here? So, the first point, you can see the price, around that 23,781 mark, the price was tending to hover around there. It stayed there for a while. So that was our start point. And the end point we were choosing because we figured that would be the local high, with the price being outside the Bollinger Band and the 89.35 RSI. Now, we do have the gift of hindsight here, so if you were predicting this as and when it was happening, it's slightly harder to predict the local top, but you'll see later on how the strategy works in theory. But just for now, that's where the local top was. We did know that, but so that's why we've put it there as well. Okay, so now if you're looking alongside the fib, you'll notice that there's the different levels. You've got the 1, 0.618, 0.5, 0.236, 0, -0.5, and -1. Okay, so if you notice there, the 0.5 is at around $32,000 US, and the 0.618 at around $30,000 US. These are on here to predict where the retracement could go to. Okay, again, we do have hindsight here, but just bear with us. So the 0.5% is a potential retracement area. Okay, and the 0.168 is where the price, if that's our sort of safety line. If the price were to breach that and finish below it, we might no longer be seeing a retracement as such. We might actually be seeing a market reversal. Okay, so that's why they're on there. So like I say, it has to actually fully breach that 0.618. Just piercing it or touching it is not enough, or just going through it. One of the tails of the candle going through it is not enough. We have to see it actually breach it and go down there. Okay. And also on the chart, you should notice the -1 level, which we're calling the next phase of our fib stages, and that is up around $57,600 US. Okay, so that there is the chart setup, and it's also where this video is going to end, rather teasingly. And in the next video, we'll be looking at how this plays out and what we think could happen going forward based on this. Okay, so be sure to check that out and to look out for the next video, and make sure you subscribe to the channel and check out all the other videos and make sure you like those, and hopefully we'll see you in the next one.